please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The stock which is on our radar is gained close to about 5%. They have recovered 280 crore from Bhushan Steel. V. Satya Venkat Rao, the executive director of the company, joins us on the phone line. Good afternoon. First, if you could tell us what was the total exposure of IFCI to Bhushan Steel and therefore your recovery?
Our exposure was around 430 crores, and as against that we have received around 280 crores. That's a very good amount considering the kind of assets which we have, especially if we compare the liquidation proceedings earlier, maybe some 10 or 15 years back. In normal insolvency cases prior to the passing of the insolvency code, the realizations could be somewhere between 10 to 15%, and what we have received as 70% is definitely a very significant recovery, and especially due to the fact that the insolvency code has really triggered the faster disposal of the assets. And this is only the beginning, because 2018-19, according to us, we have started on a very good note. And this recovery has come at the right time for IFCI.
Oh, you had to do something about it, sir, because I think the last time we had spoken to you, your gross NPAs were more than 35% approximately. So tell us, how does this change that number then? What was your gross NPA at the end of the last quarter?
Gross NPAs have seen a marginal increase from what we have seen last year. The reasons are many things, including we have been cautiously building our book.
Give us that number, sir, if you could give us. What is the gross NPA?
Gross NPAs as of March 2018 is around 8,670 crores, which is around 40% of my total loan book. And we... but there is nothing much to be concerned about it. You need to see it in terms of the recoveries which we have been affecting year on year. Because last 3 to 4 years, our annual recoveries through OTS, through SARFAESI, through assignment and all other kind of resolutions, we are recovering on an average of around 1,000 to 1,500 crores. And this year, in fact, going by the Bhushan Steel start, our recoveries will be substantially higher. In fact, what we envisage is something like around 2,500 to 3,500 crores we are expecting through recovery, because major cases which were filed under
2,500 to 3,000 crores, sir, in this fiscal?
In this fiscal, that is the kind of target which we have kept for ourselves. And this is a realistic kind of assessment which we have made. In fact, we had a business conference sometime in the last month, and we did a case-wise review, and based on the optimism that is being generated out of the insolvency code, especially the Bhushan Steel kind of offers and other things, we are confident that we will be able to reach that figure.
Just one very quickly, if you could tell us, what was the provisions you made with respect to Bhushan Steel, and will there be any write-back of provision?
Write-back may not be there, because we have made around 50% of the provisioning. And actually, in all the NCLT cases, though RBI provisioning norms are not applicable, but we have increased the provisioning coverage ratio as a matter of prudence. And of course, in some cases, there could be write-back, but in this particular case, I don't think there is a write-back as far as IFCI is concerned.
Okay, all right. Thanks so much, Mr. Rao. Well, you said there's no reason to be concerned. Looking at your stock price, all your shareholders are really concerned, but you're saying that you're going to do something about it. When you have gross NPAs at around 35 to around 40%, definitely the street is concerned, but you're sounding optimistic going ahead. And it's a good start to FY19. So let's hope that, in fact, you can deliver the goods. By the way, we're getting some commentary coming in from United Spirits on the con call. Let's cut across. Let's hear out the management.
Significantly increased investment behind our brand, and our marketing investment was up 18% during the course of the year. So if you look at that in the context of a relatively subdued full-year top line, we have put our best foot forward and said we're going to invest in the growth of this business and in the growth of the category. Underlying EBITDA margin of 13% remained broadly flat, as the increased gross profit was partially invested back into the business. I am also pleased to report a 29% reduction in our interest costs, and that resulted in interest cost savings of 108 crores for the year. Other income for the year was 206 crores, up 85% over the last year, as we managed to sell some of our non-core assets. Our improved operating performance, continued focus on reducing interest costs, and monetizing non-core assets, together with lower exceptional items, have resulted in a PAT of 562 crores for the year, an increase of 231% over the previous year. As a result, our EPS has increased to 38.7 rupees per share. On the balance sheet side, we have continued to deleverage and reduce our total debt by 20% during this year, partially as a result of better working capital management. I would also like to highlight that during the year, USL achieved upgrade of its long-term credit rating to AA+ by CRISIL and Micra and made an issue of NCDs of 750 crores. This will help to further lower interest costs in the coming future. Another point worth noting is our recent decision to split the shares in the ratio of 1:5, which has been approved by the board and is now waiting shareholders' approval. This move will increase liquidity in the stock and improve retailer investor participation due to the lower share price post the split. This stock split has historically been shown to marginally increase shareholder wealth. Overall, despite such a challenging environment, we have continued to execute against our strategic priorities. And what I am particularly pleased about is the progress we have made in ensuring that pretty much all lines of our P&L, and with the fourth quarter, even our top line, all lines of our P&L are moving in the right direction. This reinforces our confidence that the work we're doing will enable us to capture the long-term opportunity in the spirits market in India, on which we have absolutely no doubt. I would like to reassert our medium-term ambition to grow our top line by double digit and improve the EBITDA margin to mid to high teens. With that, I'm going to open up the call for questions, and my colleague here, Sanjeev Churiwala, will join me in responding to the queries that you have. Over to you, operator.
Sure, thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, thanks and congrats on good numbers. My first question is,
Ms. Pidilite is a stock on our radar. Remember, they posted a rather good set of numbers, good top-line growth. Margins were under some pressure. In fact, Mangala Malu caught up with the management. That's Mr. Bharat Puri, the MD of the company. Let's listen in to what he had to tell us.
See, we've always said at Pidilite that we manage our margins in a range rather than to a number. We're also very clear that it's about profitable volume growth. It's not about volume growth alone.
Right.
However, if you look at the last 3 years, our margins have been at an all-time high.
Yeah.
And as we see demand coming back, our focus remains on volume-driven growth. It remains on double-digit volume growth. And it also remains on profitable growth. But within a range, we're fairly comfortable of managing that.
The range would be?
We normally say we would be happy if, for example, our operating margins were between, say, 21 and 24%.
Okay.
So we're comfortable at those levels.
It's at 22% right now. So
it's at 24% right.
All right. Okay. So we'll keep an eye out on that. How has your input cost basket moved in the fourth quarter, including the currency impact? And from the end of fourth quarter to now, how much has it moved?
See, we're seeing actually, because a large part of what we buy today actually impacts our accounts 3 and 4 months later. Mm-hmm. So we have a fairly clear visibility of what's happening. Both currency and input costs are on the up. For example, our principal raw material is VAM, vinyl acetate monomer. At this time last year, it was $900 a ton. Currently, it is between $1,300 and $1,400 a ton. So we are seeing substantial increases where we believe that some of it may be temporary, but it will not come back to 900. Mm-hmm. So we have to actively manage this with a mix of price and seeing what we believe will still enable good volume growth.
So then let's talk about the one product that, or one category that you're most bullish on, which is the waterproofing solution. In your words, is the growth category. what was the percentage growth last year? And now, because it's an under-penetrated category, you have increased your advertisements. We see a lot of those Amitabh Bachchan ads. Then there is a normal monsoon predicted, improving demand conditions. Can it grow 1.5 times what it did in the last year?
See, we would definitely like that. We're very clear that most of our growth categories must grow 2 to 5 times GDP, because these are growth categories. Remember, in waterproofing...
So Dr. Fixit grew 2 or 5?
Somewhere between them, let's say.
Of course.
So remember, my job on waterproofing is to compete with non-consumption.
Okay.
2 out of 10 homes in India really do proper waterproofing when they construct. If I can take that to 2 to 4, I double the category, right? So therefore, you would see we're consistently investing in category development. If you look at, for example, the increase in our advertising spends, a large part of it is based around waterproofing, because clearly we need to educate the consumer. A large part of it is also in the field, where we need to make sure that the consumer gets the service that they require. So I definitely believe it is a growth category, as we have many others.
So 4 times GDP is what we can peg it?
You can peg it where you like. I will say 2 to 5 times.
Before we let you go, the key outlook or the key focal point that you have for FY19 by the end, say next year when we talk, this is something that you should have said that this is what we set out to achieve, and we've done that.
It has to be, especially in this environment, volume growth. We will keep focused on volume growth, because as a leader, that is your real indicator of increase in consumption and profitable volume growth. As long as next time this year you and me are saying we've delivered profitable volume growth, we will both be smiling.
All right. Your competitors, how about that? They won't be smiling? Because Jubilant Industries has a new management change. Astral Poly, their adhesives business did fairly well. Are you worried, or you think you can go ahead and maintain and grow your market share?
See, if you look at our growth rates, Mangalam, there is no doubt about the fact that, we have actually grown our market share.
Right.
As far as competition is concerned, while we are cognizant of them, we keep a close watch. We're not obsessed by them. There is enough and more for us. We have to grow categories as a leader. If we grow categories, we will get a large part of that growth, and we will keep doing well. And best of luck to my competitors.
All right, let's move on. TD Power is the next company on our radar after posting a weak set of earnings this quarter. Nikhil Kumar, the Managing Director of TD Power System, joins us on the phone line. Hi, Mr. Kumar. Good afternoon. First, if you could straight away tell us, when is the company likely to break even, report a profit? Even for FY18, it's been another year of losses. In fact, not just that, your margins too have come down to close to about 5%. When can we expect a profit and an improvement in margins?
So last year, particularly, we have had a situation where even though we delivered a top-line growth of about 16%, 449 crores versus 387 crores. We've had 2 issues that have really which have caused margin erosion. One is that we have seen that there's been a very steep increase in raw material prices, both copper and steel particularly, and we have had about 400 basis points reduction in our gross margin. We have also the 400% gross margin reduction has also been influenced by the rupee being pretty strong against the euro. Last year, our average realization was about 73.5. So these 2 major issues have impacted us. We lost about 16 crores of margin overall in the company for the whole year. But looking at this current financial year, at least on the exchange rate, we don't see that impact taking place on our contribution. But raw material prices and further hikes from where it is right now could have some impact, but not a major impact, because we have done a lot of forward covers right now for both copper and for steel.
Right.
So we will see a very muted impact on raw material price increases on our bottom line for this year. So we covered ourselves to the maximum possible extent.
Okay.
So I have already given guidance to answer the second question. Sorry, I decided
Yeah, go ahead.
Finish up. We will see. I've said we'll have about a 405 to 420 crore top line this year, and I've said that we will have 9 to 10% EBITDA margin. So our interest and depreciation is around 29 crores. So we will have something like 11 crores PBT, and the worst case situation without considering other income. This is what I'm projecting for this year. This is what I have also informed our investment community over the call yesterday.
So that 420 crores compares with what in the last year, Mr. Kumar?
388.
388. All right. So around an 8 to 10% growth is what you're looking at.
That is the worst case situation, and that's what I've indicated yesterday too.
Okay.
And there are a number of jobs for which we have bid in international markets where there is a upside potential. If we get lucky on those, I think we will be easily able to add something like another 8 to 10% top line. And then, you know, if we do that, then the margins double, basically. If we're just having an additional 10% increase in the top line, our margins double from whatever I just told you.
Okay.
So I'm pretty confident we have things under control this year.
So worst case is 8%, best case is around 18 to 20% for this year.
Top line growth, yes.
Okay. All right. And your margins, you're saying you should be able to hold at around 9 to 10% if you do the initial 420 crores, right?
Yes.
Okay. All right. What about the order inflow? Give us a sense. What was the order inflow in Q4 of last year? And what is the order inflow that you're looking at for FY19?
Yeah, so the order inflow for Q4 for our manufacturing business was 128 crores last year versus 96 crores in the same period in the previous year.
Okay.
So we've seen about a 30%, around a 30% increase in the order inflow. We're also seeing a strong order inflow in Q1.
Okay.
So I had indicated in my previous earnings call, not the one that I did yesterday, but the one before that, that I'm seeing a stronger order inflow in the company, and that will be reflected in higher sales down, you know, a few quarters down the road. And that story still continues to be there. While there could be some delays in decision making by some of our customers, say something which is supposed to get ordered last month is now getting pushed to, let's say, this month. Overall, I don't think we're not seeing any cancellations. So the order inflow is, the story is very much intact and will continue to be intact. Now, for the whole year, our order inflow last year was 392 crores versus 355 crores for the business, excluding the large order that we got for the railway business.
Okay.
If you include the railway business, our total order inflow last year was 1,142 crores.
Okay, all right. Mr. Kumar, let's keep it very simple. For the longest time ever, we have heard about the cash in your books, right? What is the current cash in your books? And people who have invested even in the IPO are not making any money. That's close to 5, 6, 7 years ago. Yet they have not made any money. So is there any intent of, you know, maybe rewarding the shareholders by some kind of dividend, some kind of buyback? And I remember a few years ago, you as well had sold. The promoter had sold stake, and that's when the entire, you know, the story of TD Power had gone wrong. So is there any intent to buy back shares, to give some kind of dividend, and your intent as well? Will you look to buy back to, you know, maybe creep into the shares? It's at a 52-week low today.
Okay, so let me just talk about your first comment that investors have not made money.
Yes.
The stock price, we listed at 256.
Yes.
And there has been ups and downs in the stock price, but it went up to something like 420, 430 also. And there are a number of investors who have sold at different points of time between 256 and 425 and have made money on the stock. So to say that nobody has made money on the stock, that is a wrong statement from your side. People who have bought the stock at 425 and now who face the situation at 160, yes, there's pain for those investors. But this is not an exceptional case as far as we're concerned. This is how, I guess, stock.
What are you going to do about it, Mr. Kumar? Mr. Kumar, what are you going to do about it? We are just referring to those who are invested in the IPO. If they
I can only deliver. Yeah. I am responsible for delivering the performance of the company in terms of top line and bottom line.
Okay.
And what happens to the stock price after that is not in my control.
Yes.
But what is the cash in your books? I mean, will you look to reward your shareholders?
Now, we have 168 crores cash in the books. There is no decision right now to have any share buybacks or to send money back to the shareholders at this point of time. Nigel, the energy markets in general, the power equipment manufacturers worldwide. Right now, the industry is in shambles. There is a lot of uncertainty. There's overcapacity. The demand has fallen off. And there is a lot of flux in the industry right now. So it is actually, this cycle has been, getting worse and worse over the past 3 or 4 years. And it's not, we don't see this situation improving dramatically anytime in the near future. If you look at large companies like even General Electric, for example, of course, they are of a completely different scale compared to us, but we're in the same business.
Right.
In the businesses that, where they are and where we are, which is the power business, I mean, their numbers are just terrible. In that sense, if you look at our numbers, we've been fairly consistent over the years. We haven't delivered growth, that's for sure. But we have delivered, I would say, performance in the sense that we have been able to replace a lot of the dip in the domestic demand with export business, which is sustainable and which is also still growing. Plus, we have diversified the company's business into railways, and we have brought in the potential. We brought in this order, which will deliver 100 crores per year in 2 years from now, and that's going to add. That's going to just add to the margin. So, my answer to you about the investors who have put in money, I thank them for their patience. There is significant upside in the company's fortunes with the railway business and with what we're doing domestically and internationally with our regular generator business. Please be patient for a little bit more time.
All right. Thank you, Mr. Kumar, for joining in. That's TD Power System guiding for an improvement in the company's profitability in